All right, hey guys, we're back in our Facebook video series, and today is Wednesday, so we're doing Mailbag Wednesday, going over common questions I get, unpacking them, because chances are lots of people have the same question. So today we're talking about what is phantom income. So I'm going to give you a little background and unpack that, give you some definitions, some terms, so you can understand where I'm going. So if you have or you're an owner in a flow-through or pass-through entity, I'm going to use those terms interchangeably, right? So if you have an S corp or a partnership or a sole proprietorship, right? Any one of those entities is what's called a flow-through entity, meaning you pay the taxes on the income of those entities on your personal tax return. Those entities don't pay tax themselves. So you know this, like, for example, if you have an S corporation, the S corp itself does not pay taxes other than payroll taxes or maybe a franchise tax, which that's really out too. It doesn't pay income taxes. What happens is the S corp issues a form to all of its owners called a K-1, showing their ownership in the entity and then their proportionate share of the income of that entity for the owner to pick up that income on their personal return. Essentially, it passes through or flows through to the owners. So that's what we're talking about: flow through entities, pass through entities, and the income associated with it. Okay, what is phantom income? If you've ever been a partner in a partnership, now this could be an LLC that has multiple members, which by default is a tax partnership. So if you're unsure what that means, why an LLC would be considered a tax partnership, look back in my other videos. I kind of unpack the taxation of LLCs. Okay, if an LLC, taxed as a partnership or an S corp, earns income and it doesn't distribute it to you, right? Like, meaning you didn't get the cash in your hand, you could still pay tax on that income. So here's what I mean. Let's take a very simple example. An S corp that you own 100% of. And let's just say that after all of the expenses in the current year, that S corp made 100 grand, like net income profit to the business. And let's just say, to make the example easy, that at the end of the year, the company had $100,000 in its bank account. Like, all of the profits were sitting in the bank account. In that example, and it had paid no distributions out, in that example, the owners of the company would pay tax on their share of 100 grand, even though they got $0 in distributions. Okay? Meaning, made 100 grand sitting in the bank account, no distributions. What do they pay tax on? 100 grand. And here's the point. Flow through entities, you pay tax on the money when you make it, not when you take it. So that confuses a lot of people, meaning, I don't have any distributions. How could I be taxed? And it's because the company earned money and allocated it to you, or you're supposed to pay tax on your share of that income, right? Regardless of the money you got in distributions, a totally different thing. Let's move that example forward just to give you the extreme. Okay, so in the example I just gave you, company started, made 100 grand, and on the last day of the year, 100 grand was sitting in the bank account. It had distributed $0 to the owners. Let's just say on the first day of the next year, the company decides, we're folding up, want to close the business, we want to distribute all the money to our sole shareholder. But we don't have any taxable activity. We have no activity for the year other than taking the money in the bank account, paying it to the shareholder. In that example, in year 2, the owner would pay tax on 0. Because there's no earnings, but he got $100,000 distributions. So you can see I'm making the very extreme point that you make money, or you pay tax on money when the company makes it, not when you take it out of the business. And this confuses people, hence the term phantom income. Meaning, in my example, I had $100,000 of profit but no distributions. How am I paying the tax on 100 grand? Well, that's because that's how it works. Similarly, in the next year, I got no income allocated to me, and I got $100,000. How am I not paying taxes on it? It's because you had no income in that year. Your distributions are from profits. They are not the profits, right? Important distinction. So, phantom income is the income or difference between the income allocated to you and the amount you actually received in cash. Now, it can be a positive or a negative amount. So, this is something that trips people up a lot. If you become an owner in a flow-through entity, be ready for this. Be ready for the year where the company made a bunch of money, but didn't distribute it to you, maybe because they reinvested the profits or they're just holding off for a rainy day, retained earnings kind of thing. Be aware of this. It could really trip you up and cause a much unwelcome surprise in the form of taxes that you weren't prepared for. So the easiest way to account for this or to take this into consideration is to work with somebody throughout the year that does tax planning, such that they have access to that information, can say, hey, I know you haven't gotten any distributions, but like this company's really doing well, making some money that's going to be allocated to you. So work with somebody throughout the year, have great books, set that foundation for you to not be surprised at tax time and have phantom income, which can really trip you up. So this is Mailbag Wednesday. Answer questions commonly asked to me or other CPAs. If you have a question or a comment, drop it below. I'd love to answer your question on next week's Mailbag Wednesday. But otherwise, we'll see you tomorrow on Tax Tip Thursday, where I'll unpack a quick tax tip for you, something that can help you run a better business, save on taxes, or just save on your personal taxes. So we'll see you tomorrow. All right, guys, thanks.